Capital adequacy ratio. Banks in the modern world face an inherent risk of insolvency. Since the banks are so highly leveraged, there could be a run on the bank any moment if their reserves are considered to be inadequate by the market. Hence, banks must maintain adequate capital in their vaults if they want to survive. However, what constitutes adequate is subjective. This is generally measured in the form of a capital adequacy ratio, and central banking institutions all over the world prescribe the level of capital that needs to be maintained. In this article, we will have a closer look at the capital adequacy ratio and why it is of paramount importance for banking institutions. Ensuring solvency of banks. The capital adequacy ratio is important from the point of view of solvency of the banks and their protection from untoward events which arise as a result of liquidity risk as well as the credit risk that banks are exposed to in the normal course of their business. The solvency of banks isn't a matter that can be left alone to the banking industry. This is because banks have the savings of the entire economy in their accounts. Hence, if the banking system were to go bankrupt, the entire economy would collapse within no time. Also, if the savings of the common people are lost, the government will have to step in and pay the deposit insurance. Hence, since the government has a direct stake in the issue, regulatory bodies are involved in the creation and enforcement of capital ratios. In addition to the capital ratios are also influenced by international banking institutions. Limits the amount of credit creation. Theoretically, reserve requirements are supposed to limit the amount of money that can be created by banking institutions. However, in some countries like the United Kingdom and Canada, there is no reserve requirement at all. However, here too banks cannot go on creating unlimited money. This is because the capital adequacy ratio also impacts the amount of credit that can be created by the banks. Capital adequacy ratios mandate that a certain amount of the deposit be kept aside whenever a loan is being made. These deposits are kept aside as provision to cover up the losses in case the loan goes bad. This provision therefore limits the amount of deposit that can be loaned out and hence limit creation of credit. Change to the capital adequacy ratio therefore can have a significant impact on the inflation in the economy. Credit exposure. The capital adequacy ratios are laid based on the credit exposure that a particular bank has. Credit exposure is different from the amount loaned out. This is because banks can have credit exposure if they hold derivative products, even though they haven't actually loaned out any money to anybody. Therefore, the concept of credit exposure and how to measure it in a standardized way across various banks in different regions of the world is an important issue in formulating capital adequacy ratios. There are two major types of credit exposure that banks have to deal with. Balance sheet exposure. Balance sheet exposure is the amount of risk that a bank is exposed to on account of the activities that are listed on its balance sheet. This would include the credit exposure that result from the loans that have been sanctioned. It would also result from the credit exposure that it is the result of the securities that have been purchased by the bank. Hence, an analyst can simply look at the balance sheet and come to an exact estimate of the credit exposure of any bank. Off-balance sheet exposure. On the other hand, there are some risky activities that a bank takes that are not listed on the balance sheet. For instance, banks may issue guarantees to some parties on behalf of some other parties. These guarantees are not financial transactions that can be listed on the balance sheet. However, they do create credit risk in the process. Similarly, the bank may purchase derivative products which do not have any effect on the balance sheet today. Thank you.